Well, back on the vaccine trade, and with Pfizer news out a couple of days ago, it's as if investors have completely forgotten about the US election. But is this the news that will dominate markets for the rest of the year? With his take, we're joined by Sean Fenton from Sage Capital here in our Barangaroo studios. Sean, welcome back to AusBiz. There has been a little bit going on the last few weeks. Let's go and start off with the election. It seems to have taken a back seat for the other time being, given the other vaccine news earlier this week. Looks like President-elect Biden will go and take the presidency on January 20. Still looks like we'll have a divided Congress. What's the investment implications there, in your opinion?
No great changes, but clearly market hopes of big fiscal spending, big stimulus. Democrats talking about $2 trillion in stimulus packages is probably on the back seat. So Republicans seem keen to do a deal, but it's more like $500 billion, which still seems like a lot of money to me. But the market was probably slightly less buoyant around cyclicals and infrastructure style spending stocks, and was pretty happy to come back to growth. Bond yields remain lower. That stimulus just not as aggressive. So the initial reaction was probably more of the same from the market, but yes, might have been overtaken by more recent news.
Absolutely. Just sticking with the election just for 2 seconds. So the initial reaction from the market was to go and rush back into tech stocks, rush back into healthcare. Now, obviously, two sectors that have performed really strongly in the lead up to the election and for the past decade or so, realistically. The initial reaction, do you think it's the right one, even regardless what's going on with the vaccine story in the background?
It's a big question to ignore the vaccine story in the background, but I think that's sort of the right reaction in that you've got a reasonably sort of more balanced political tussle going on there. So you won't get some of the more extreme policies. So there's probably one of the big negatives of Biden coming in was potentially increasing corporate taxes, which could hit the tech sector, more aggressive on pharmaceutical pricing, probably more aggressive in terms of fracking the energy industry, shale gas, joining Paris Agreement, those sort of things. So there could be some trade-offs there. So it's probably generally positive for the market. Less fiscal spending allows bond yields to be lower, less chance of corporate taxes being pushed up, generally positive for things like tech and growth. So the market reaction, I think, was pretty spot on to that election outcome.
So A+ for the initial reaction, but then of course wake up Tuesday morning this week here, and we found out that Pfizer's released early phase 3 results, but very promising, more than 90% plus efficiency when it comes to the vaccine that it's developing at the moment. We've also got talk that Moderna might come out with similar results in a few weeks' time. Eli Lilly as well had an approval from the FDA for a treatment to go and counter the mild and cases of coronavirus. So it looks like we're getting on top of that potential threat, albeit it's still very bad at the moment, particularly in that northern hemisphere. What's the investment applications from that? Now, we saw the rush back into value. Cyclicals really boomed earlier this week. But we're seeing growth continually go and outperform over the last 12 or so years since the GFC. Where does the balance lie? What's the risk as to what's the better trade moving forward?
Yeah, you don't want to become too myopic with these things, and certainly positive vaccine news. We do see likely positive vaccine news to still come all the way up to the end of this year and next year. So that's going to create a backdrop of certainly reopening, quite likely stronger growth, stronger bond yields. It does favour that value recovery trade. So it's not as if we're coming off rock bottom. The market's been looking ahead and pricing in the prospect of a vaccine and a recovery down the track. But the positive news just accelerates some of that, and particularly that high efficacy. You've had Russia come out with their Sputnik 5 vaccine, had 93% efficacy. So there's quite likely going to be more than one, which allows people that are vulnerable to be immunised early and just to get life back to normal. So I think you do want to be thinking about earnings recovering in a more rapid sense. So identifying particularly those stocks that have been impacted, what the earnings changes are. Bond yields can move up, but there's no way central banks are tightening rates in a hurry. They're probably committed to a bit of yield curve control and keeping rates low. So what we won't see is probably bond yields driving lower and lower, and just valuation impacts lifting that growth trade. So growth stocks can still do well, but you've just got to be more selective. You've got to identify those that are going to continue to grow their underlying business and deliver earnings growth and can actually push through any sort of headwinds from slightly higher bond yields. Those that have just been lifted on valuation effects, hot money and crowding, they're probably more vulnerable to rotation. So we do like value over growth, but that doesn't mean wholesale throw out all your growth stocks and buy anything in value.
Absolutely. I agree with you entirely when it comes to the real yield scenario. It's very difficult to see central banks wanting to go and see real yields going to lift into positive territory. That would spell trouble when it comes to this recovery. Putting it all together, what sectors do you like? Are there any companies that you like at the moment? Is there any areas that you don't like?
Yeah, look, certainly across the broad range of those recovery trades, the obvious things like travel stocks, we like Qantas and corporate travel, a bit of Flight Centre there. The thing that will come back is obviously that shift. We went through a decade or so of consumers, households shifting their spending from goods, material things to experiences like travel, eating out and services. And with a vaccine and a return to normalcy, we see that coming back. So travel-related stocks, we see some value in things like shopping centre REITs like Centre Group. People will come back, foot traffic will come back to those high-quality malls, and certainly those stocks that have received a big hit from switch in spending patterns will probably find it harder to grow going forward. So the big shift to online, it's not going away, but it won't accelerate at the same rate, and there's probably going to be some difficult comps in retailing to work through. But also, just some of those stocks that have been lifted by pure valuation effects, probably time to move on and look at a few others.
So maybe look at the quality space of the growth if you can go and do that in a certain way. Sean Fenton from Sage Capital, Chief Investment Officer, thank you so much for joining us on the program today.
Pleasure.